I would say that we are in the preliminary stages of a double dip recession.
I do think that the labor market continued to worsen in the second quarter of this year.
I don't foresee that there's going to be a major improvement upon the February 2026 final announcement that comes out.
Anna, do you agree that there was net job destruction starting in April 2024?
Yeah, I agree.
Today's episode is brought to you by Teucrium. Learn more about how agricultural commodities can play a role in your portfolio by clicking the link in the description. Over 900,000 jobs that we thought were created turns out might not to have ever existed at all. This is the news from the Bureau for Labor Statistics, and I am joined by two economists and economic thinkers who have been ringing the alarm bells on this for a long time. I'm joined by Anna Wong, Chief U.S. Economist at Bloomberg Economics, and Danielle DiMartino Booth, Founder and Chief Strategist at QI Research. Welcome to Monetary Matters.
Thank you for having us.
Happy to be finally here.
Danielle, you've been talking about this for a long, long time, and a few days ago, it finally happened. Jamie Dimon is commenting on it. It's on all the big podcasts, on the New York Times, that the revisions from March 2024 till March 2025, the job numbers have been downgraded by 911,000 in a preliminary estimate. The final number will come out next year, but it's preliminary estimate. So what you've been saying, Danielle, for a very, very long time, and people have been doubting you, including myself, to be honest, it finally has come to pass. Your thoughts?
You can only follow the revisions and the real-time data as closely as what the officials will allow. But there were signs and there were revisions leading into this revision that suggested that barring dramatic improvement, net job destruction had begun in the second quarter of 2024. And that continued through the third quarter. And it looks like we might have come out a tiny bit in the fourth quarter and then double dipped right back in the first quarter. And these are statistics and analysis and data that we've been putting out for months now. And I guess what's most striking, Jack, is that if you look at the trajectory going forward, it looks like the depth of the current real-time revisions, in other words, the 2-month revisions that are reported every non-farm payroll Friday, the trajectory right now, and given one of the final pillars of the job market, which is construction, is starting to crumble, that is a sign for us that we're actually going to gain downward momentum going in. We can talk a lot about the details. From my vista here in Texas, the housing situation is grave. And that's why we're looking at least for now, downward momentum going into the second half of this year.
There's a lot of numbers and methodology to get into. Anna, I want to give you your first word. You write in a research piece that taking the preliminary benchmark estimate at face value, last year's labor market looked recessionary. Tell us about that.
Yeah, so there's a lot that Danielle just said that I agree with. We agree with her description of the contour of the labor market, that it started weakening very rapidly in spring of 2024, had a first negative payroll print in August 2024, where there was no hurricane whatsoever. There was it's not related to natural disaster. So that was real weakness. And then there was another negative one, probably a negative 32K job growth or contraction in October 2024. And that was partly because of the hurricane. And then things rebounded before dipping again in the first quarter of this year. And I do think that there was a double dip. I think maybe where Danielle and I differ is I have doubts on whether we are still in the deepening phase of the business cycle. I do think that the labor market continued to worsen in the second quarter of this year. So the revisions we saw 2 days ago did not cover this second quarter of this year. But I think we had a deeply contractionary payroll month, probably in June. And I think after all the revisions are done, June 2025 probably see payrolls contraction of negative 50K or negative 60K even
per month.
in June.
Okay, but I thought, didn't we already have the negative revision of minus 160,000? I thought it went from 147,000 to minus 13,000. Sorry.
Right, but I was saying that eventually, once all the revisions are completed in 2027 February, then we would see that June of this year is probably more like negative 60K.
Wow. Okay, so you're saying that we lost 60,000 jobs in reality in June of this year. That would be about 200,000 fewer jobs than were initially reported. Right now, we have them at losing 13,000 jobs. And as you write, Anna, that job loss and negative monthly payrolls are a hallmark of a recession.
Yeah, so NBER's the Business Data Cycle Dating Committee said that the two most important indicator they have been putting a lot of weight on over the past decade is non-farm payrolls and also income excluding transfers. And particularly, they like to look at 3 months or smoothed payrolls. And even looking at 3 month moving average of payrolls, the preliminary benchmark data we saw also showed 3 month moving average was like 6,000 in the middle of last year, when the break even was more at 200,000. So that was, if you want to talk about the gap between break even and the 3 month moving average, that gap was the largest last summer. Right now, you could argue that the break-even job growth is more like, there's a range of estimates. Some people think it's negative given immigration pattern. We are at 70,000 for break-even. So even at, say negative 60,000 for June of this year, you're still probably only 60,000 below break even to maybe 100,000 below break even, versus last year you were like almost 190,000 below break even in some months. This is why I think, in terms of the second derivative, the pace of contraction in this business cycle right now, we're getting smaller and possibly even out of the deeply contractionary phase.
And right, that break-even rate is the amount of jobs you need to add every month for the unemployment rate to stay constant, because people leave their jobs, newer people are added to the labor force, and the like. Danielle, what are you seeing in the revisions right now? Anna just said that she thought that the final number for June job number could be negative 60,000. Talk to us about the scale, because in last year, for example, the mean revision was negative 20,000. So we added fewer 20,000 jobs. Now these revisions are looking bigger and bigger. Just share us your thoughts here.
Jack, what you're describing right now, I think, is momentum. We have to remember the backdrop, the context. Pumping $15 trillion into an economy in a very short period of time since the CARES Act was first passed in March of 2020. You really can stop an economic cycle on a dime when you pump $15 trillion into the economy. Companies were also having a hard time sourcing employees. When you look at the work week, which right now the work week is down where it was, the number of hours people are working, it's where it was back during the Great Recession, the financial crisis. And we always say at QI, hours before bodies. It's clear that companies are trying their hardest to not have to press through with getting rid of employees. And yet we are now finally seeing this momentum increase to the downside. And I think that that's why we're seeing these revisions deepen. And kind of what we're looking at is more right now, because we feel like we know what happened in the past, but our clients only want to know what's happening tomorrow. So what we're trying to figure out is where we're headed from here. I'm sitting in the great state of Texas. It's the second most populous state in the nation. It's the largest exporting state. And we employ a heck of a lot of people. Our payroll growth here has been outsized compared to that of the rest of the country. And boom, today in the initial jobless claims data, it was led upwards by the state of Texas. Now, we've seen that coming. We've told our clients it's coming. We had a 13-month high in warn notices in the month of July in the state of Texas. So we knew that into August and September, once these warn notices work through companies, when they file a warn notice, they have 60 to 90 days to give people to prepare to lose their jobs. So now we're seeing that filter through into the jobless claims data. And we're also seeing it in the soft survey data. Back in March, in fact, almost to the day in March, when we saw what we call the holy grail of economic indicators, that's higher unemployment expectations from the University of Michigan. When we saw that hit 66% in March, we actually did a kind of a look forward based on prior cycles back to the 70s of when you cross that 60% line of Americans perceiving the job market as weakening. And what we saw, Jack, is that is it 3 months out, 6 months out, you have a certain percentage gain historically. 07, 09, it was much larger. But in any event, with today's jobless claims report, we see that 6 months forward from March, from when an overwhelming majority, more than 60% of Americans said, you know what, I don't care what the data say, we think the job market is weakening. So since then, we've seen a 17.9% increase year over year in initial jobless claims. That's slightly more than the post-1970s average of 15.4%, but we're on our way to that 12-month average of being up 30% year over year. And that's where we think jobless claims are headed based on historical content and historical precedents. We don't think it's going to be as bad as 07, 09, but we are indeed expecting, because we're right there with where we should be historically. We saw a little blip down in University of Michigan higher unemployment expectations. I know I'm getting in the weeds here, but it's really critical because there's a difference between Danielle saying we're in recession and following layoff announcements and following the bankruptcy cycle and predicting what revisions are going to be. There's a huge difference between me saying it and Joe and Jane Q, working Americans walking the street, seeing it with their own eyes. So once we see this Rubicon crossed, and we remain north of 60%, with, again, at QI, we call this our holy grail of economic indicators. Once we cross that 60%, and we've remained above that 60%, on average, 12 months out, your initial jobless claims are up 28% year over year. We're right on track to get there, and we're starting to see that come through in the more real-time weekly data, as well as things like civic science. They had their job finding capability come out today. That hit the lowest level on record as well. Again, Jack, there's a big difference between you and me and Anna talking about this and using models and looking on screens and writing reports. Huge difference between that and when Americans are like, oh, gee, I can't get a job. And I'm not going to get a job if I lose my job. And that's where we are right now.
Your point being that confidence feeds on itself. And if so many people are pessimistic about the labor market, number one, that could be a leading indicator that the labor market really is weak. And two, the weakness could feed on itself.
That's correct. But right now, it's a much more fundamental issue. I mean, again, I'll go back to Texas. It's the worst state in the nation. 87% of home builders here are laying people off. The contractor, subcontractor, those layoffs are even deeper. Carrier came out at a Morgan Stanley conference a few days ago and said that it sees, based on, Carrier makes a ton of air conditioning systems, but it sees now by the end of the year, residential construction and sales of its HVAC units being down 40% year over year. They're saying that they're in the worst quarter in a decade. So we built a lot of homes coming out of the pandemic. We sold a lot of homes at really high prices. We're just now seeing these FHA delinquencies come through. And we know that these FHA forgiveness options go away in October, which is, by the way, next month. So we fully anticipate that, unlike prior cycles when housing led, right now housing is lagging. But it's coming up. It's bringing up the rear. It's a nasty caboose, and it's coming in strong, and it employs a lot of Americans, Jack.
Right. And that preliminary revision that we got a few days ago in construction was negative 29,000. As you pointed out, in the cyclical sectors, there were a particular weakness, negative 95,000 revisions for manufacturing, for wholesale, negative 110,000 for retail, negative 126,000. Danielle, and then Anna, can you speak to the methodology? How is it possible that the Bureau of Labor Statistics has gotten it this wrong? Is something going on with the models? Is something going on with the data collection? I know you two have been very early on this, and also, can you just speak to revisions are normal, but just how out of character is this very sharp negative revision, and how does it compare to the maybe more moderate upward revision you normally see? First, Danielle.
So in 2009, we saw a revision of negative 902,000 on an absolute number basis. The negative 911 was bigger. On a percentage basis, though, we saw negative 0.6% revision compared to 09, which was negative 0.7%. So truly, we have not seen the deepest on a labor force participation population adjusted basis. We've not seen the deepest revision in history yet. I doubt we'll even get there in the current cycle. But as far as what is missed, we can talk about response rates all day long. We can. But I think it really comes down to employee identification numbers. It sounds like a stupid answer, Jack, but we live in a gig economy. By the end of next year, 50% of all Americans will have a gig job of some kind. And if you have a gig job, you create an EIN, you create an employee identification number. That feeds through to perceived births of businesses. And it speaks to, I think, and it was interesting, the Bureau of Labor Statistics did not say, it blamed companies for not responding correctly about their own headcounts. The BLS a few days ago, with the statement that accompanied these revisions, did not place any blame on its birth-death model. But when you have a structural shift in the US economy, Uber didn't exist in 2009, remember? It was born in Paris in 2009. But we have this massive gig economy. We have all of these EIN numbers being created. But prior to 2009, when you created an EIN number, you were probably establishing a real business, maybe even with employees, and not just having an EIN on file with the government because you're working for DoorDash. So we have this massive distortion in terms of births and deaths amidst, by the way, a historic bankruptcy cycle, right? S&P does a great job. Bloomberg does a good job of tracking large bankruptcies. S&P Global does a good job of tracking bankruptcies north of 2 million in liabilities, but we're right where we were in 2010 right now in the bankruptcy cycle. So all of these businesses are being destroyed, and yet there's a model that imputes massive job creation based on business births. And I think that is something, the Department of Labor has opened up an inquiry, an audit of the BLS and its methodology for inflation metrics. This is yesterday, for the employment numbers. I think that they're going to look at this birth-death model and say, of all of the things that create the imputations that you use, this one might be the most broken. And by the way, I would add one thing on response rates. In October 2013, the household survey, which creates the unemployment rate, the response rate was 90.1%. It was 67.1% in July, Jack. Unemployment rates never revised. But all I'm saying is what you see is not what you get, but you only get payrolls revised, not the unemployment rate.
Right. And that birth-death ratio, we're not talking about births or deaths of human beings. Fortunately, we're talking about births and deaths of businesses. And you're never going to, go to knock on everyone's door, on every business's door, and say, are you working? Are you employing people? You have to use assumptions, of course. But you're saying that the assumptions and the models could be, in today's economy where the gig economy is dominant, slightly flawed. Anna.
I agree with what Danielle just said. I think, in terms of the contribution of the birth-death model to the 911,000 downward revision, we estimate that the model contributed about 400,000, so almost half of it. So that's quite substantial. And the rest of it is due to other related issues, such as, a firm that didn't die but was in deep contractionary mode, could be not responding to the establishment survey. It's understandable. So I think the model, BLS has used the same model, but the inputs in the model has changed, especially during the pandemic. And a lot of this structural change that Danielle pointed to, this gig economy, and also YouTubing, people do just young people now going on YouTube, like yourself,
Like you,
starting
Jack.
your own company. Yes, Jack. Um, so, and this is like a phenomenon out of the pandemic. So many people start doing these things during the pandemic. So it's, I think, BLS methodology for birth and death model, uh, uh, it was really worsened by pandemic specific era um, structural changes.
And Danielle, what do you think that the final revision is going to be that's going to be announced next year? Anna's got this great chart showing that actually the revisions for 2023 to March 2024, when they first were announced, was 958,000, a negative revision, but then it went to 818,000, and then ultimately, quote unquote, only 598,000. So still over 500,000 jobs that we thought were created that weren't created, but the revision got less and less bad. Interestingly, this revision was more bad than the implied numbers from the QCEW. Anna, you had 833,000 negative revision. The actual one was 911,000. So Danielle, what do you think this final number is going to be?
This is where Anna and I differ the most. And I don't foresee that there's going to be a major improvement upon the February 2026 final announcement that comes out. A lot of this has to do, again, with the momentum that I was talking about. And as well, if you look at what's happening on a state by state level inside the QCEW data, it looks to us like the 9/11 is going to mostly to stick, if not possibly get revised further into the negative. I've seen a lot of my peers out there suggest that it looks like payroll losses gained momentum October, November, as Anna was saying, of 2024. And in fact, October was the first time that we saw kind of a substantial enough rise in the number of people who were unemployed to start also triggering some historic thresholds. But again, I think that we have seen, after a post-election kind of brief spurt of confidence in what could be, I think we've seen further retrenchment and a double dip, and that appears again because of what we're seeing in the housing sector, because of what we're hearing in the retail sector, because of the fact that we know that consumers are more pinched than they have been, because it looks like we're going into a credit crunch as well. By the way, we just had a major subprime lender here in my state, Tricolor, just go boom. And by the way, that was a non-depository financial institution loan, which is a whole different story for a whole nother day. But that was the first kind of crack in the edifice that we've seen in the private credit world. And when you have credit curtailment in this level, with this level of uncertainty, and the consumer retrenching to the extent that they are, and delinquencies rising and by the way, banks start actually saying it out loud, Mr. Diamond. When you have that, and I think David Solomon echoed what he said, and there have been a few other banks that have come out and said, okay, maybe we are in the R word. Once you get this confluence of factors, when credit collides with fundamentals, it really can create an adverse feedback loop that is hard to escape, at least for some time. You've got to get the consumer balance sheet back in good standing. Anna and I were actually talking yesterday. There is some fear, at least on our part, that all these millions and millions of Americans who are not paying their student loans back, who fully expect to get a tax refund come February, are just going to have that garnished away. So you're going to have yet another hit to the consumer in a long line of hits going forward. We've got to have the consumer be able to borrow again and access financing to buy things. And I don't see that improving for some time.
Are you a sophisticated investor concerned about today's markets? With the ever-present potential for stock market corrections and the risk that bonds won't provide the hedge that they used to, you may want to consider adding an asset class that has historically offered stability when you need it most. The prices of agricultural commodities such as corn, wheat, soybeans, and sugar typically move to their own rhythm, driven by factors like weather and geopolitics, not the factors that move more traditional assets like stocks and bonds. Since inception in 2012, every time the S&P 500 has had a correction of 10% or more, the Teucrium Agricultural Fund Benchmark Index has outperformed. Getting exposure to agricultural commodities has always been tough for individual investors, and while it's not possible to invest directly in this index, Teucrium offers ETFs designed to give investors price exposure to these markets. If you're a professional investment advisor or a self-directed investor managing your family's wealth, click on the link below to learn more about how incorporating agriculture into your portfolio can help diversification and protection. Thanks for listening. Let's get back to today's interview.
Can I play the devil's advocate and kind of rebut Danielle on some positive things that I'm seeing? Okay, so all the things you mentioned. Also, I was very concerned with earlier this year, but I see a couple tailwinds, powerful tailwinds, which I think could lift the economy. Which is number one, a significant drop in trade policy uncertainty and all sorts of policy uncertainty. And so uncertainty earlier in the year has, suppressed investment, and you know this decrease in uncertainty should unleash some investment impulses in the next 2 quarters. Second, I think this, and this is the key, is the Fed. I think my lesson from last year is what the Fed decides to do could change the course of the labor market. So initially, I thought the Fed is going to be leaning on concerns about inflation, because I think that the Fed staff is actually very hawkish. I think they still do believe that tariff will produce persistent inflation. However, their forecast has been proved wrong by the last 4 months of data, so their credibility with the FOMC might not be as good right now. So the Fed is now going to cut, and if they are going to project cutting 3 times this year, I do think that in combination with the decrease in trade policy uncertainty could offset some of this negative income shock from the tariff and from all these Biden era policies expiring. And on top of that, next year we get the one big beautiful bill tax rebates in April. That's another tailwinds. And on top of that, there's this wild card of what is Fed's reaction function now, given all that's happening with Fed politics.
That's a lot to talk about, Anna. We will talk about the Fed, the administration's ongoing conflict, let's call it, with the Federal Reserve, as well as with the BLS. But first, Danielle mentioned a subprime auto lender in Texas, Tricolor. It hits on so many different themes that you two focus on and that I've been covering on. Well, number one, this subprime lender, I think, had gotten warehouse financing from a lot of other banks, including Fifth Third. And that is a subtopic I just talked about, non-bank financial loans and basically loans to financial institutions that the banks are lending to, with my interview with Bill Moreland. But Danielle, I got to talk about immigration, okay? Because I read that this subprime auto lender made a lot of loans to undocumented immigrants, and immigration, and I'm only now starting to realizing this, is so key into the conflicting data we've seen in the labor market. For some reason, why, I don't know the methodology, but the household employment number had been quite weak, and the non-farm payroll number had been very, very strong. And that's why in 2022 and 2023, people were talking about this extremely hot labor market. Because for some reason, I think the employment was not being captured at immigration, and the non-farm payroll was. And now the non-farm payrolls have been revised down. In January, we got a huge, not a revision upwards, but employment spiked like magically, because it finally took into account the excess, people that have been in the country that was not previously accounted for. And, credit to you, Danielle, for pointing that out on the quarterly census and wages and stuff. But so just how has immigration been shaping these very conflicting signals from the labor market? And now that we have a sharp reversal in policy, what is that going to mean for both the non-farm payroll from the establishment survey as well as the employment figure, which goes into the unemployment rate from the household survey?
Anna really hit on the crux of what the impact of out migration is. And of course, we're really feeling it here in Texas. Grocery stores that rely on food stamps, healthcare, it's all being very impacted. Even housing, because there was a lot of demand that was kind of under the radar, if you will. And actually, the fact that we've had out migration and the remittances, by the way, the income into the economy that used to accompany all of these workers, that's a thing of the past, if you will. But the fact that we've had construction payroll losses despite immigration outflows is quite extraordinary. But Anna got to the point of we don't need to create as many jobs in the U.S. economy. That's what this means. So it's a source of relief, if you will, because the minimal threshold, she's at 70,000. I think a lot of people are closer to 30,000. I'm closer to Anna's number in terms of what I think the economy needs to create to maintain a stasis in the labor market. But to me, the immigration mainly has to do with relief for the labor market, because you're pulling supply away at a time that demand is falling for labor, but one is going to work well in offsetting the other for now. But again, that's why it's telling that we're still seeing construction layoffs, because in theory you wouldn't need to be laying people off because you've lost a huge chunk of your workforce that's no longer that's no longer viable in the country.
Right. Anna, your turn. Can you please kind of explain it to me and the audience as if, I'm a 5-year-old, because it's quite confusing to me, to be honest.
So I think there are three main labor market indicators: the unemployment rate, which is based on the household survey, and the monthly non-farm payrolls, which is based on the establishment survey, and finally you have QCEW, which is basically a census record. It's the record of 95% of the universe of jobs. This is the most accurate measure of the labor market. But we only get it every quarter, and also benchmark the monthly measure of employment to this quarterly measure. So I think the first two measures are all off in some ways. The unemployment rate, based on the household survey, has been mismeasuring the population growth last year, undercounting population growth, whereas this year they're way over counting population growth. So this year they're basically assuming every month that population is growing 200,000 per month, about 2.4 million over this year, which is probably 3 or 4 times higher than the actual number. But so in that sense, it's kind of odd. It's not very good sense of slack. And then the non-farm payrolls also, perhaps also undercounted due to overcounted payrolls because of birth death models. It's unclear. It's just a conjecture that they're able to capture undocumented immigrants, but I actually think it's a conjecture. It's actually not at all clear. And so I think what one has to do is to think about first conceptually, what does it mean when you have a significant drop in population growth, which is that there's less labor slack. Because last year, when there's truly maybe 200,000 people entering into the labor market every month, you need a high rate of job growth, and the economy in fact was only producing 10,000 per month. So that was a lot of labor slack, and a good unemployment number would have been able to capture that slack, but it was not able to, because so even with the unemployment rate, one has to bring in other things to adjust. For example, maybe you should bring in marginally attached people who dropped out because they're too discouraged. Then in fact the unemployment rate looks to be more like 6%. Or you bring in other alternative indicators, like Danielle mentioned the University of Michigan series, and you do a regression on unemployment rate, or you take jolts and the quits rate and the hiring rate, and you regress it on the unemployment rate. And they would tell you that if you look at this more holistic measure of unemployment rate, assuming that and everything is measuring properly, unemployment rate was actually increasing more like to 5 or 6% last year. Whereas this year, given the population decrease, it doesn't mean that there's as much labor slack as last year. So I think that's the bottom line.
Okay, so in terms of the household survey, which the unemployment rate comes from, both the numerator and the denominator were too low because they were undercounting the amount of people that were coming into the U.S. And as such, you think that the unemployment rate could have been, the real unemployment rate could have been 5% or 6, even as high as 6%, because they don't revise the household survey number. But now, you will see it in the future in the forthcoming numbers. Now you think they are overcounting the amount of people coming into that. What does that mean? Does that mean that the employment number, which was likely too low over the past few years, is actually now too high? And again, we're not talking to the non-farm payrolls, which was revised. We're talking to the household employment number. Anna.
Yeah, so last year, so one would think that unemployment rate is a ratio. So as long as both things are measured in the same rate, it should have no impact on the accuracy, right? But the thing is, undocumented immigrants tend to have higher unemployment rate than the average person. So we did dive into the household survey microdata, and we found that new immigrants who have only came into the United States in the last 2 years, their unemployment rate was more like 11%. So if you think that the household survey has accurately weighted the share of undocumented workers, which they're not, then that should that should have bias, that would have boost the numerator in terms of the unemployment, right? But so I do think that the ratio, the error in the numerator and the denominator are not the same. In fact, if the undocumented was accurately measured, unemployment rate would have been higher last year. So conversely, this year, it could be that because the denominator is exaggerated, because the population growth, the labor force is not as great, it's not growing as fast, that and also employment growth is just the numerator alone that is too big might have been biasing the unemployment rate too high.
My biggest issue with the unemployment rate and with the household survey and with all of this discussion about the numerator and the denominator is we don't know what the starting point is. We don't actually know where we are. But I do agree with Anna that we are seeing extraordinary levels of presumptions in terms of the population growth that is simply not occurring. In fact, I saw an estimate a few days ago that suggested that the U.S. population this year could decline for the first time ever.
Because immigration is down so much, as well as, I guess you could say, immigration in terms of deportations. And also, Danielle, does this mean, so both of you seem to agree that because the labor supply is going down, the jobs numbers don't have to actually be that good, because they don't indicate a slack in demand. They show there's supply going down. Is there a risk, though, that explanation causes us to be complacent and we, people, I already kind of see it, and I already kind of believe it, to be honest, of relying on the fact that immigration is down so much to justify, non-farm payrolls of 50,000. And it points, it's fine that we're only adding 50,000 jobs that will later be revised to 20,000 because immigration is down. But actually, it still is weakness. What do you think, Danielle?
Well, I still think that we've seen a legitimate increase in the unemployment rate itself, right? It wasn't up quite one full tenth of a percentage point, but it was up 0.8 of a tenth of a percentage point last month with rounding. Jack, what I really think, and again, Anna and I are on different sides of this. What the current backdrop with population now means is that you've got to have more joblessness to increase the unemployment rate. So in that sense, if we're going to see a rising unemployment rate going forward, that means that it's harder to get it to go up, and that means that it's more indicative of where we are.
Danielle, how do you think the Federal Reserve thinks about these numbers? Powell has made some mumblings that the original jobs numbers are not as good as they are because of these revisions. How do you think the Federal Reserve is thinking about the strength of the labor market?
So 2 press conferences ago, Chair Powell basically threw out non-farm payrolls. He wasn't that flippant about it, but he basically tried to move the focus, move the lens to the unemployment rate as being the primary indicator that the Federal Reserve is going to be following going forward. So be careful about the bed you make, because then you have to lie in it, is what I would say to him, especially given the fact that we're seeing the U6, the under unemployment rate, go up much more at a higher pace than the U3 unemployment rate. And that's, look, we've lost 1.416 million full-time jobs since January. That can't be displaced just by part-time job creation. Certainly not on the income side.
Mm-hmm. And Anna, what do you think about how the Fed thinks about these numbers? And
so I think they would be thinking about it also in terms of what that implies for inflation trajectory. And I think Powell's interpretation of how the immigration surge the last couple of years contributed to inflation is quite telling. So the Fed's view has been in the last couple of years that the immigration surge had a net reduced inflation. Which I actually disagree with. In fact, I think internal Fed model, we are talking about FERPIS, which is the workhorse general equilibrium model, which Danielle probably really hates. But that model, if you feed in the population shock that we saw in the last 4 years, actually say that the equilibrium effect on the economy is net inflationary. And I think that is also consistent with the month-to-month our CPI react over the last 4 years, which is like how many months when we had upside CPI when it was due to hotels? How many months? A lot. So I actually see, so now we're on the flip side of things, which is that, okay, immigration is slowing quickly. Would this be a net disinflationary impact or a net inflationary impact? And I think the Fed internally are still talking as if the immigration decrease would be inflationary. But fortunately, I don't think Powell is one of them. He did remove the phrase in his opening remarks at the FOMC meeting, in the last two meetings. That sentence that says the labor market is no, actually, I take that back. Actually,
yeah,
there was a phrase in his opening remarks that says the labor market is not a source of inflationary pressure. He deleted that in the last two
really?
meetings. Yes, he deleted that phrase. So I think internally the Fed still thinks that immigration reduction now is inflationary. But I would disagree with it. I think it's actually disinflationary.
And so the market is pricing in a very high chance of a 25 basis point cut in September next week, actually. And we're going to get this out quite soon, probably by Friday. So what, Danielle, you've been pushing for a 50 basis point cut. Tell us about that.
Well, we think it's justified on so many levels, especially when you get into the absolute crush that we've seen in margins. We're negative on a year over year basis in the PPI and trade services, which is emblematic of the fact that companies are not able to pass these price increases along. Their margins are getting absolutely crushed. And the areas that tariffs would impact to the greatest extent, which appears to be what keeps the Fed up at night, just God love them, right? Because the CPI declined from 2018 to 2019. It must have been really long ago. They can't remember that far. But if you look at the areas where there has been pass through, these are the areas that, according to real-time credit card data, are the weakest in terms of consumption. You must have pricing power, excuse me, I'm putting the cart before the horse. You must have purchasing power. Purchasing power must be manifest in order to have pricing power. I beat my head up against a brick wall with all of these tariffs are inflationary. I'm like, by whom? Who is going to charge the higher prices? Because who is going to pay the higher prices? And that's when you get crickets. Well, no, companies have to pass the price increases along. I'm like, great, they did. They did in furniture sales. Now they're going to have clearance sales. They tried to do it in RVs. Now they're laying off people. It's you can't squeeze blood out of a rock.
It is a credit to the strange things going on in the labor market. We're over 40 minutes into our interview, and I haven't talked about the producer price index or the consumer price index, which came out this week. So producer prices actually surprisingly dropped by 0.1% from the month earlier. And the core CPI increased 0.3%, and the overall increased by 0.4% month over month. So a slightly divergent signal. Anna, tell us your interpretation of this inflationary reading. And I know that the producer price index measures something slightly different than what we think of as producer prices. Because when I hear producer prices, but basically the prices that companies pay, wholesale prices, and then consumer prices, the CPI is the prices that consumers pay. So to me, a hot CPI would actually be good for margins, and a negative PPI wouldn't be that bad because companies are paying less. But tell us your analysis of these two key readings that we gotten of the past few days.
What has befuddled me in terms of the who pays the tariff debate was why is firm margin, profit margin still so high? Because we saw in second quarter earnings, it was pretty elevated. Because my reading of all the data that we see, import prices, CPI, PPI, all of that is that consumers are not paying much of it, as Danielle pointed out. But import prices is showing that US is taking all of it. So somebody is taking some of it, and where is that somebody? It's like a chair, musical chair. Who's the next version? So PPI should be showing that. So I think this week's PPI did show that. Finally, it squares some circles. So the PPI, the trade margin, the trade services margin, final services trade margin, that is a proxy of firm margin, and that finally dropped. And I think that reflects that firms are getting profit hit. But I think that the tariffs all along has been a red herring when it comes to thinking about the inflation trajectory. I think the story is, and this is where I differ slightly from Danielle, we agree that the tariff is not immediately inflationary. The, it, the Fed was never successful in bringing inflation down to 2%. Even without Trump, it was not going to 2% this year. Why? Because of services. In fact, the goods inflation has been on an upward swing since middle of last year. As financial conditions start easing in preparation for Fed rate cuts. If even without Trump, with Kamala, we could have had still have 2.8% inflation. And I think this year we saw that indeed core CPI bottomed at 2.8 and has been coming back up. I think the analogy is like man overboard. When you are boating or in a sailboat, the man is overboard. If you don't rescue that man immediately, that's 2% inflation, and you just drift farther and farther away from that percent, the 2% inflation target, and you're not gonna get it. I think the Fed, as well as both the Trump administration and the Biden administration, none of these three parties are willing to do what's necessary to bring inflation back to 2%. And the boat has sailed, or the person is lost in the ocean, that 2% target.
Warren Buffett, many months ago, he was asked about tariffs. He says the tooth fairy does not pay the tariffs. And I think we all agree with that. The tariffs are paid by someone. This question of tariff incidence, or as you say, tariff pass through. So quite literally, 100% of the tariffs are paid by the importing company. So if Walmart is importing from China or Vietnam, Walmart pays the tariff. But the question is, do they pass those costs on to consumers? Do they demand price cuts from their suppliers in Vietnam, China, all around the world? And or do they take the hit in terms of their profits? And there's some combination of all three, probably. But Anna, could you just clarify what the data so far indicates about this? Because you talked about how you're seeing it in PPI, those transports and trade going down. And then also that data you referenced, I don't have the exact number. I don't know if it was a decline of 60 basis points or a decline of 80 basis points, and it was some annualized figure, but import prices did decline, right, in the most recent personal
Okay,
consumption expenditure
right.
thing. Yeah.
So neither import prices or PPI prices include tariffs in them. So with import prices, the decline you're seeing is just not including tariffs. So once you include tariffs in those import prices, which is what we do, we calculate the tariff inclusive import price by sector. We see that most sectors sees 90 to 100% tariff pass through. U.S. side is paying for it, for 90 to 100% of these tariffs. And second, we double check this with looking at the profit margins data by sectors for China and U.S. And what we found that, for example, in the same sector, the Chinese firms' profit margin are way lower than the U.S. firms for the same sector. And this is the reason why in bargaining between China and US, for example, there's just not much room for China to lower their profit margin because they are having a deflationary price war within China right now. There's no room. Whereas US firms are still having above normal margins from this the pandemic era. So we actually, it makes sense for US to be taking most of the brunt on this tariff, and it makes sense for most of it to show up as profit compression in the US. So that's the story from import prices. And in terms of PPI, so within PPI, you have stage 1, 2, 3, 4, and then final demand. So when you look at the aggregate PPI index, it actually does not tell a very clear story. When you look at the entire, you have to look at the entire supply chain. From you have the imported part, which is the most upstream as a good enters the country, and then you have various stages. You have wholesale stages, retail stages, logistics stages, and the trade margin stage, which PPI also captures, and that tells you the profit margin. And that portion of the PPI tells you this week that firms are eating the tariffs through profit margin compression.
And if you had to put a number on it, Anna, is it 70% companies are eating it, 30%
Yes,
prices are going up? Roughly
that's
that,
it.
yeah?
Well,
Wow.
as of today's CPI, before today's CPI, my number would be 95% of tariff eaten by US, and from 95 you subtract 23% of that is borne by consumers, so that gets you around 70ish as profit compression through the entire distribution, right, of supply chain at various stages. But then today's CPI shows that tariff pass-through has slowed significantly. In fact, the firms in, as Danielle said, sporting, appliances, in many of these super tariff exposed items that has tried to raise prices in the last 3 months. For example, sporting goods have raised price for like 8% in the last 3 months. Audio have increased price 12 months. They are having to cut back. They now have to offer discounts because consumers don't have enough to buy. So today's data suggests that in fact the consumer is only eating way less than 23%, possibly around 15% or so only, which means that, well, it looks like firms, the profit margin data for the firms are going to eventually show that the firms are taking maybe 80% or a lot more of it.
So, Jack, if I could interject here, I think the
Of course.
Supreme Court, I think all of the justices on the Supreme Court should watch this, and then they're going to bring Anna up as an expert witness before they decide on whether the Trump tariffs are constitutional or not, given the magnitude of what American companies are eating. So just careful, Anna. I think you might be called up as an expert witness.
Well, I was just saying that their profit margin are elevated also compared to
That's true.
2019.
That's true.
Yeah.
They would want you to skip that part. The companies would, that is.
And Danielle, that speaks to a dichotomy, which is that the S&P 500 profits are elevated and their margins are at or around their all-time highs. And I know the Q2 earnings were very, very strong, but so much of that is companies that sell services and technological services and goods that are not either, they're exempt from, they're made in China and they're exempt, or they're services and there's no tariff on them. So everything we're talking about in terms of tariffs is on the real world, and a lot of people work on building these things and on selling these things and work at companies that do those things, but it's mainly goods, and the goods, the S&P 500's exposures to goods is not what it was in 1960. And even though China is a manufacturing superpower, if you look at like a China ETF, the dominant companies, I would say, like in the United States, are somewhat technology companies. And so the firm data that Anna, that you're referring to, it's either from public data, or it's publicly traded securities data, or it's from the China macro data, but that doesn't necessarily represent what is in the stock market. So I think that just goes to show that the stock market could be doing very well, while there are a lot of big challenges in the economy.
Oh, definitely.
Yeah. I mean, that's why you're seeing the majority of bankruptcies in the consumer discretionary sector. I mean, you can see where the goods, where this profit margin and this margin compression is manifesting in the economy. It's just going to work its way back, because, as Anna said, they've got a war chest of prior profit margin cushion to work down.
Mm-hmm. And Danielle, so companies, obviously they want to raise prices. They're not raising prices because they, out of the goodness of their heart. It's just that demand is not strong enough to contain that. What is an economic analysis of what happens when companies profits goes down? What happens?
They cut costs.
Mm-hmm. Yes.
He's giving you an opening, Danielle, to assert your thesis.
No. Look, the thing is, we've been seeing this for some time, right? Whether it's companies saying get back to the office, return to the office as a way of using, as a way of pushing through stealth layoffs. The complexion. All you have to do is look at the demand side, is look at the ability to land a job if you lose yours. The hiring freeze aspect, the cost cutting, all of that is nobody argues with me about that part of it anymore. They just argue with me about the layoff part. Again, companies are in a very aggressive cost cutting stance. A lot of them are adopting AI and don't even know what they're adopting. They just know that somebody from on high has said, our margins are getting squeezed, cut costs. End of story. However you can. And we see this in the CEO and the CFO in their confidence surveys.
Right. And it's CEOs are not hiring, and they don't have to fire people for headcount to go down, because there's natural attrition. Anna, tell us about what you're seeing in the layoffs. Danielle's been ringing the bell, pointing to high profile layoffs. Looking at the official layoff data that is at Fed, I think that official data is low, giving credence to the Fed Chair Powell's claim that hiring is low, but also firing is low. So everything is kind of in a stasis mode. What is your analysis of that picture? What do you have to add?
We have been in this mode for 2 or 3 years. In fact, Danielle probably would agree with me that everything started slowing in the labor market in late 2023. Mm-hmm. It's been a very, actually not resilient and pretty tepid job market for more than 2 years. And this is why I'm more optimistic, the more optimistic of the two here, because it's been a long time. I also think that when we look at the jobless claims data recently, and we plot a nice histogram of across states to see how the concentration, how widespread jobless claims are, which jobless claims are a proxy for layoffs, and we see that most of the increase are actually so far, except for today, where Texas clearly shows up as an outlier. But so far in the last 6 months, it's been concentrated in Maryland, Virginia, Washington, D.C., maybe Arizona. But it seems to be related to DOGE. And in fact, jobless claims in many other states have seemed to even decrease compared to a year ago. To me, the labor market last summer was worse than the labor market this summer. It seems, relative to the labor supply.
Now supply is so much lower is what you're saying, Anna.
Yeah. And also, in terms of layoffs, I also think now was not the peak layoffs. We still have seen pretty low layoffs recently.
Yeah. We look at it through a slightly different prism. So we look at the percentage of states with rising year over year jobless claims on a not seasonally adjusted basis. And in fact, this last week, on a not seasonally adjusted basis, jobless claims broke out of their last 5-year trend, and in fact, we're at the lowest. We're at the highest since 2017, the pandemic notwithstanding. But anyways, we look at jobless claims through the prism of percentage of states, percentage of population. So as of this week, you've got 53% of states with rising jobless claims, 65% of the population now is in a state with year over year rising jobless claims. And again, we consider that threshold to be closer to the 75% mark as to when, you're really, it's kind of DEFCON 1.
I mean, we could still be in a recession. I think it's a very likely possibility. All I'm saying is we seem to be in this recession for a while already, and we are probably either in the very late stage or early stage of another news cycle.
So I'm glad you brought up the R word. I'll start with you, Danielle. Yeah, what does this labor market data reveal about the economy? And in particular, I think there's normally a cycle where actually the job market is one of the last things to fall in a recession. So typically it's in the middle of a recession. You already start to see this, whereas other financial conditions would have tightened earlier. Spending would have gone down earlier, when actually, financial conditions are extremely easy. I mean, we just had an IPO today of a crypto lending company, everything is, the party's just getting started on Wall Street. Spreads are at their all-time lows or close to them. And, how could we have been in a recession already if, and Danielle, we've been talking about this for a while, like if personal consumptive expenditures is still growing at 5% and the consumer is, still growing, still spending 5% more than they were last year. And then after inflation, that's like 2%, but that's still not recessionary. So how is it that the labor market is showing a weakness while you're not seeing that weakness in other sectors necessarily?
I think, Jack, what's important to point out here is that this extraordinary contribution to GDP by way of AI. There's been a graph running around that shows that PCE right now is contributing less to GDP than AI, which is really extraordinary. And if you look on a shorter term run rate basis, we actually are seeing declining PCE on a real basis over the last few months. So that really is kicking in right now. We don't feel recession. We won't feel recession, Jack, until the stock market kicks in. And the reason that we think we're in a double dip recession, and this is something more along the lines of 1980, 1981, is because we saw a blip, we saw a spurt of optimism directly coming out of the US election. And that appears to have reversed itself. But what we would be expecting to see right now, to answer your question, to drill down, Jack, would be rising backlogs. And that's my bottom line. On the services side and on the manufacturing side of the economy, we would expect to see rising backlogs right now. We're not. And until we see pent-up demand building, pent-up backlogs rise, demand for labor rises. And to Anna's point about investment, until we see capital expenditure expectations begin to rise, I want to see this. I really do. I want the big, beautiful bill to just pop and make all of this happen. But we have to see backlogs come out of contraction in order to see then, because that leading indicator then leads what you say is lagging correctly, which is unemployment. When I see leading indicators say we're coming out of this, I'll be raising the expansion, and then people will tell me I'm nuts at the time too.
Anna.
I think there is a backlog of investment, and this is why I'm more hopeful. I do think it will happen soon, and because of AI, we did a study on whether the popping of AI sentiment, which seems to be happening as people realize that the sci-fi level of AI is not going to be achieved, how that might affect the trajectory of investment, and we have come down to the bottom line that there will still be a linear trajectory in investment because the second phase of AI, which is the adoption part, still requires a lot of data centers, a lot of power, and a lot of semiconductor chips, all of which are in shortage right now, which is why you need to invest. And on top of that, if the Fed is cutting interest rate, it will move this forward. It will serve as a tailwind to the economy.
So you think that capital expenditure and business investment is going to drive the economic cycle more than definitely a strong labor market and more than consumer spending?
Oh, for sure. Because as I mentioned before, the NBER business cycle dating committee, they have 5 or 6 indicators, and sure, one of them is consumer PCE expenditure, right? But when you look at it, PCE expenditure, as Milton Friedman is most known for, consumer smooths their consumption over time because consumption does not respond to income shocks every year. They respond to a present discounted value of income stream, which is why even in recessions, PCE consumption doesn't really drop sharply. It's only the component within the PCE that's very cyclical. For example, spending in hotels, spending in airfares, those would fall in a recession, and we did see those things fall earlier this year. I think that's just why I thought back in March, April to June, it was very bad because you're seeing deflation in airfares, deflation in hotels. Now you're seeing accelerated inflation today in the CPI report in airfares. Airfares popped 5%, hotels 2%. This doesn't look like a floundering economy to me right now.
And what about specifically AI capital expenditure? I've seen some estimates that it's at 1% of GDP, and by other estimates, sets to grow even more. Just these numbers, how big are they relative to the economy, and just how much could they
They're
contribute?
massive. They're massive. So we calculated that in the first half of this year, AI related stuff added 1 percentage point to GDP growth. So with that, but still, I mean, GDP growth was tepid this first half, but without AI, we would be deeply negative in the first half. So AI was able to drive the economy forward despite all these trade shocks and all the stuff. It's a very powerful tailwind, and we are expecting uh, the contribution of AI to slow a little bit in the second half, but not by too much, because there's still too much shortage in terms of what we need in the infrastructure to sustain the adoption demand in the future.
Danielle, I want to give you the last word. Everything that we've been talking about, how does it inform your views of, are we in an economic expansion or are we in an economic recession? And depending on your answer to that, is it an early stage, mid stage, or later stage of that expansion or recession?
When I was referring to backlogs before, that's just from working inside the Fed for almost a decade. I was referring to regional Fed services and manufacturing surveys, and I was referring to those backlogs. So given the fact that they're still in deeply negative territory, I would say that we are in the preliminary stages of a double dip recession.
Okay, so that thesis you shared before. So we were in a recession sometime around 2024, exited it, and then we are now in a recession again, is what you're saying.
So the hard data, again, from the census, which is 12, as Anna said, 95% of U.S. employers, 12 million U.S. employers, showed that net job destruction began in the second quarter of 2024. Economics 101 tells you that if net job destruction has begun, then that means that some prior month that preceded that is when recession was onset. That's just 12 million employers. It's not my opinion, Jack. It's just hard data. So we know that that started.
What data are you referring to? Because New York Times says that basically the data from March 2024 to March 2025, it was around 1.7 million, and now minus the 911,000, it's looking like it was a gain of 850,000. Still, over half of the jobs that were created did not exist, but that is not a job destruction like you described. So tell us what you're referring to, please.
So again, we actually did the pure analysis based on the quarterly census of economic and wages.
Oh.
I will actually send you, Jack, you've seen the charts. I'll send you the charts that go back to the Q2 of 2024. They're very
Okay.
simple charts. You can just throw them up.
Yeah,
but
definitely.
based on, God bless the New York Times, based on what we saw, that's when net job destruction began. And again, it looks like it continued, but to a lesser extent in the third quarter of 2024, possibly popped out in Q4, went back in Q1 of 2025. So
Yes.
I'll
Okay.
send
So
you the session.
please do. So you're referring to the QCEW and the business BED. I have been able to interpret the results of the BED by looking at the numbers that come from the actual, non-farm payrolls and the revisions. But the BED to me is just like ancient
Well,
Greek. So
we provide sequential revisions based on each release. So
yeah.
we provide numbers along the way and we label them in big font.
Anna, thank you, Danielle. Anna, do you agree that there was net job destruction starting in April 2024?
Yeah, I agree.
Mhm. Okay, there we go. All right. Well,
Going home because you're talking to us about recession, right? What I didn't
yeah.
finish saying was, at least in the history of the United States, we've never seen job losses begin unless recession had already begun before it, because jobs are lagging.
Yes. It's a quite an interesting cycle. So you think we're in the beginning of a double dip recession, the beginning of the second phase of a double dip recession, Danielle?
I do. And the fact that companies are actually borrowing right now to finance their AI investment, to me, that's what we call a good old fashioned canary.
Yes, they're starting to. Yes, they're starting to borrow big time. It's crazy that the some of the most profitable and biggest companies ever are now looking to borrow money. They don't have enough money.
One's going to win, though, Jack.
Oh, in terms of making the mega AI.
One of these AI players is going to win, and then they're going to swallow the rest of them whole.
Yeah, so that is a longer term concern that maybe by longer term it could only be in 3 years.
Right.
But
No can of worms right now.
thank you both so much. Of course, people can find you, Danielle, on Twitter at DiMartino Booth, and Anna, people can find you on Twitter at Anna Economist. Don't forget to follow me at Jack Farley 96. Leave a rating and review on Apple Podcast and Spotify. Thank you both. Thank you everyone for watching.
Thanks, Jack. Thanks, Anna.
Thank you.
Thanks for watching. Remember to click the link in the description to learn more about the Teucrium Agricultural Fund Benchmark Index. Until next time.
Thank you. Just close the door.